Welcome everybody to Volatility Trading Strategies. So if you're an investor in the various volatility exchange-traded products on the market, like VXX or SVXY, chances are good you check the VIX Futures term structure several times a day. VIXCentral.com is the go-to source for many of us, and for me personally, I look at it upwards of 20 times a day. Now let me ask you a question. How many times have you heard, whether that be in a blog or maybe on Twitter, somebody say that all you have to do is check the daily Contango percentage, and that should tell you whether you should be going long or short volatility? You might hear someone say that Contango is at 5%, so we have a green light to short volatility. Or maybe they say that the term structure is in backwardation, and that means we should be buying the VXX. It's pretty common, right? But the problem with this is that the VIX Futures term structure should not be viewed as a static measurement. We have to also take into account the number of days to expiration. Let me show you what I mean. So first, let me get a little disclaimer out of the way here. Volatility products are risky, and they do require a high-level understanding in order to navigate the space safely. And they're also very complex, so traders should be using a multitude of volatility metrics and take it all into account before actually taking any trades. I personally have 7 or 8 indicators, and I combine that information together to reach my trade decisions. What I'm going to talk about today is just one of those indicators, and it is by no means a comprehensive view. And in fact, it is just scratching the surface. But let's take a look at the VIX Futures term structure as it was yesterday, September 18th, 2018. So remember, volatility products are not stocks, and they don't derive their price based on the typical supply and demand dynamics like other financial instruments do. Instead, the price is derived based on a daily rolling, that is buying and selling, of the front 2 months of the VIX Futures. And then how these futures are valued in relation to each other, how they move around, and how they converge to the spot VIX. So if this M2 value is higher than the M1 value, that's a condition we call Contango. It means the front 2 months are upward sloping, and all other things being equal, that may be a small tailwind for short volatility products. If the opposite is true and that M2 value is lower than the M1 value, that's called backwardation. And again, all things being equal, that may be a tailwind for long volatility products. Just as an example, here's the VIX Futures term structure on Friday, February 2nd, 2018. You can see that on that day, M1 was 1562 and M2 was 1497. With M2 lower than M1, this is 4.16% in backwardation. So for anybody who understands volatility products and how they work, they would not have been short volatility on February 2nd when the futures were in backwardation. And also this means that they would not have been short volatility the following Monday, February 5th. Now if that date rings a bell, it should. That's Volpocalypse, Volmageddon, Volnado, whatever you want to call it. That's the day that the VIX index spiked 115% and our old friend the XIV was terminated due to a single day loss of 95%. Now with all due respect to everybody who lost money on that day, I think enough time has passed that I can say this without sounding too insensitive. I hope so anyway. But nobody should have been short volatility on that day when the VIX Futures term structure was in backwardation. But back to our Contango example. In this example on September 18th, 2018, we have M2 at 1470 and M1 at 1302. That means Contango, and on an order of magnitude of 12.9%. That's actually pretty high in historical context. Here's a chart showing all the values going back to the introduction of VIX Futures in 2004. You can see that the long-term average Contango is 6.4%. So a reading in our example of 12.9% is actually in the 89th percentile. Higher than 89% of all values since 2004. So clearly this is a strong signal to short volatility right now, right? 12.9% Contango. Well, on the surface, this does seem to make some sense, but there's a big problem with this conclusion. Of course, beyond just being far too limiting and only one piece of the overall puzzle, but even just looking at that one signal, it still doesn't take into account the number of days to expiration, which is important. Every day that goes by, the volatility products hold slightly less of the front month M1 futures, and slightly more of the back month M2 futures. The curve is constantly moving forward in time. Now at the end of the monthly expiration cycle, everything resets. The front month future M1 here goes off the board completely. The back month future M2 now becomes the new front month future M1. M3 becomes M2, M4 becomes M3, and so on. The whole curve shifts down and we start a new monthly cycle. On the day that happens, the near-term volatility products will be holding 100% of that new M1 contract and 0% of the new M2 contract. As we move forward in time, the daily rolling changes that composition to start favoring the back month, and then it expires again. Rinse, repeat every single month. In this chart right here, on September 18th, 2018, this is the last day of the monthly cycle. That means tomorrow, this M1 value will be gone. M2 will become M1, M3 will become M2, and that can change the level of contango, sometimes quite dramatically. Check out the contango difference between M3 and M2 right now. M3 is at 1511, and M2 is at 1470. That's a difference of only 2.79%. Now, a lot can change in one day, but assuming everything stays more or less the same overnight, we could see contango drop to low single digits by market open. 2.79% contango is in the 29th percentile of value since 2004, way below the average of 6.4. That's a big change, from 12.9% in the 89th percentile to 2.8% in the 29th percentile. Anybody making trade decisions based on the level of contango might find their bias changes with this new value. But it really shouldn't, because nothing fundamentally has changed. All that happened is one day went by. The contango percentage gets reduced substantially, but the volatility risk premium is still the same as it was before. There's no reason to get into a new trade or exit a current position simply based on the passage of one day. But that's exactly what could happen if a person had a limited understanding of the futures and was actually trading based on a static term structure. If your strategy said, for example, greater than 5% contango, that's a green light to short volatility, that would have had you allocated to trades for a few days leading up to expiration. But the next day it could easily drop from 12.9% to something below 5%, and you'd be exiting your trade. But you wouldn't be exiting your trade because of a change in fundamentals. It would simply be because of a technicality. So what can be done to avoid this? Well, there's no right or wrong answer here, and every trader is going to have a different method of dealing with this problem. But what I would suggest is that you have to devise a method of viewing the VIX Futures term structure as a dynamic indicator, somehow taking into account both the futures values and the days to expiration. Now, maybe that means you're going to start including M3 in your calculations. Or maybe you're going to use a rolling average to smooth things out. Some people do it normally and then make some adjustments a few days before and a few days after expiration. Or maybe you just want to use M3 and M2 alone and forget about the front month entirely. Get as creative as you want and devise a strategy that takes everything into consideration. That's what I do. I want my trade signals to be based on the actual fundamentals of the volatility market instead of just surface changes in values from day to day. So if you have any questions about this video or any of the other ones on my channel, please don't hesitate to reach out and contact me. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.